Good afternoon. I'm Patrick Armstrong. I'm Chief Investment Officer at Plurimi Wealth, and it's January 14th today. Biggest news in markets that I'll be talking about is inflation, and the United States just printed CPI at 7%. That's the fastest inflation since 1982. So 40 years, we've not seen inflation higher than what we had in 2021. And inflation has a lot of consequences. Probably first and foremost is its impact on how the Fed will run its monetary policy. And higher inflation is pushing the Fed into a corner where they're going to have to hike rates. Originally, I thought the Fed would be hiking in May. I think they're going to be hiking in March now because inflation is so strong, job market's quite strong as well. And I think they're probably going to be hiking 4 times in 2020-22. Previously, I expected 3 hikes. So Fed rhetoric, Fed minutes, strong employment numbers, all of those things point to more Fed hikes. And equity markets have been weak to start the year because of what the Fed will possibly be doing. We've gone back over the last 40 years and looked at what's happened to equities after the Fed started hiking. And generally, equities have moved higher following the beginning of a Fed hiking cycle. So on average, equity market's gone up 6.5% 12 months after the first hike. So we expect that hike to begin in March. Equities won't necessarily go up, but generally when a Fed begins a hiking cycle, it's because the economy is strong. And that's the position we're in right now. We expect the US to grow at above 4% economic growth. Unemployment's down below 4%. Spending power is strong. We think the economy is strong. We think earnings growth continues. Equities should be able to weather a Fed that hikes. What the Fed has done historically, though, is that their hiking cycle probably begins at the right time, but they've hiked too quickly or for too long. And at the end of every hiking cycle, you've almost always had a recession immediately following. So the white line on this chart shows the Fed funds rates, and the red lines show the red columns show when there's been recessions. And you can see when the Fed hikes rates, a recession almost is inevitably followed shortly afterwards. And I think the Fed has learned from this, and they may not hike as far as they have in the past. Monetary policy is very accommodative. Zero interest rates aren't appropriate for the economic growth, for the inflation numbers we have and the employment numbers we have. I think they'll be a little more cautious than they have been in the past, and maybe we won't engineer that recession, but it's towards the end of the Fed hiking cycle when equities have really struggled in the past. And within equities, I think you should be investing with inflation as part of your mindset. It's a dominant theme of what's happening in the economy right now. And the equities I think are best positioned are companies that have pricing power. So companies that have a good that's in high demand and they can charge what they want basically. So higher input prices aren't going to change their profit margin. So companies with dominant market shares, some of the big cap tech companies like Apple, Facebook, Meta, their advertising input costs don't affect their profit margins to the same extent. I think owning companies that have scarce resources or that they're producing goods that are in shortages, those are the kind of companies that are almost benefiting from inflation. Owning those are a good way to hedge against inflation. Look for companies that are producing cash flow now and growing cash flow at a rate faster than inflation. That's a way to preserve your purchasing power. Your companies aren't having long-term cash flows discounted at higher interest rates because they've already generating cash flow. So companies that are no earnings tech companies are going to struggle in an inflationary environment. And finally, companies that have real assets, infrastructure, assets that basically will preserve purchasing power. Their assets growth will go up with higher inflation. I think infrastructure assets, any company that has large amounts of property and generating cash flow from owning those properties, those kind of companies do well in an inflationary environment as well. So that's it for today. Best of luck in 2022, and we'll speak with you again soon.